Today, I'm going to cover the key things that you should do and avoid doing after your 1031 exchange to remain compliant and to protect your investment. Hello everyone, my name is Ryan Stuhlman and I am President of US 1031 Exchange Services. Successfully completing a 1031 exchange is a major milestone, but there are several important steps you need to take afterward to ensure you're staying within IRS regulations and making the most of your new investment. In this video, we're breaking down the do's and don'ts for the period after your 1031 exchange is complete. So let's dive right in. So first and foremost, you actually want to maintain proper documentation. This includes sale and purchase agreements, closing statements, and any correspondence with your qualified intermediary. Having these documents on hand is crucial if the IRS comes knocking with questions about your exchange. Make sure you report the exchange on IRS Form 8824 when filing your tax return for the year the exchange took place. This is an essential step to ensure the IRS recognizes the exchange and that you've properly deferred your capital gains taxes. Be sure to keep detailed records of the depreciation on your replacement property, as it will impact your tax liabilities down the road. Depreciation is an important factor in calculating future tax obligations when you eventually sell the property. Keep in mind, one of the key IRS requirements is that the replacement property is used for investment or for business purpose. So make sure the property is being used in compliance with this rule. Personal use can disqualify the exchange and lead to penalties. Be sure to stay up to date on the performance and condition of your replacement property. This will help you ensure it's still meeting your investment goals and making the returns you expect. And lastly, always keep an eye on the future. If you're planning to sell again, consider another 1031 exchange to continue deferring your capital gains taxes. Proper planning can lead to years of tax savings. Now getting into the don'ts. A common mistake is converting the replacement property to personal use too soon. The IRS generally expects the property to be held for investment purposes for at least 2 years, so don't rush into changing its use right after the exchange. Selling the replacement property too quickly can trigger IRS scrutiny and potentially disqualify the exchange. A good rule of thumb is to hold onto the property for at least 2 years to avoid issues with the IRS. Next, be aware that different states might have different reporting and tax requirements, especially after the exchange. Stay on top of state-specific tax laws to ensure full compliance. Don't overlook the basics. Make sure your replacement property is properly insured and maintained. Neglecting these aspects could put your investment at risk and cost you down the line. Finally, stay on top of any additional filings or notifications as required by the IRS or state tax authorities. Missing a deadline could lead to penalties or complications with your exchange. In summary, the work doesn't stop after you complete your 1031 exchange. By keeping proper documentation, complying with tax reporting, and making sure your property is used appropriately, you'll ensure your exchange stays compliant and beneficial for your investment. And of course, avoid common pitfalls like selling the property too soon or changing its use too early. If you have any questions about what to do after your 1031 exchange, give us a call. Thanks for watching, and I look forward to seeing you with our next video.